Episode 524, Trading Justice Podcast. Mark and Matt on a Sunday, recording this for you. A lazy Sunday, Matt, but every day in the freaking market for the last 3 weeks feels like a Sunday, right? Like the market's been open.
Market has been open. There's no doubt about that. Have we seen any follow through on any price action? Have we broken out of the market ranges yet? No, it's still hovering right south of that 4,200 zone. What's been interesting is it's held up better than probably you would have expected this long in some degree of consolidation pattern. We're well over 2 weeks. I think we're now approaching the 3-week mark of this continuation right between 4,100 and 4,200. If you were to tell me that the market was going to hang out for 3 weeks with it at a 4,100 to 4,200 zone, with all the information that has been coming into the market, all the geopolitical conversations, some really important earnings reports, economic reports, a Fed meeting, a whole bunch of Fed speeches on higher for longer, and the market's going to be hanging out at 4,200 to 4,100 in that time frame, I would have taken the under on that analysis. But here we are. Market's been sitting there between 4,100 and 4,200 zone. It's had multiple opportunities to break out one way or the other. It's had some degree of causation, meaning catalyst, to break out one way or the other, probably more towards the downside, but it hasn't. And you know, it's one of those situations where you're looking at the market right now and it's probably a little bit of glass half full, glass half empty, and it's probably going to be how you see your individual stocks in that environment. Because one thing we have seen is sectors separate from one another. We've seen the haves and the have-nots from a stock perspective. It's been a top-down market. There's no doubt. It's been an Apple, Microsoft type conversation. Has that carried a lot of the rest of the market up into a little bit of resistance? Yeah, but it isn't broadly supported out there. So a lot of glass half full, glass half empty to start this week right now.
Yeah, no, and let's just let's power through. I want to spend most of our conversation today on earnings because it's the only thing of relevant, and it is the big topic this coming week. Yeah. But when you look at the major storylines in the market, right, like we haven't gotten resolution, right? So if someone wanted to say, all right, let me find a logical reason outside of zero DTE why the market's held up, right, and done nothing, well, recession. Where are we at on recession, Matt? We're about the same spot we were 7 months ago, right? It's coming, maybe
next week. We know that.
It's coming, I think, maybe, keeps getting pushed back. So no resolution there, right?
Listen, we live in an economic cycle that has both bull markets and bear markets. Yes, the recession is coming. It will always be coming. It's just a matter of timing. And we've been doing this song and dance of, are we going to have a recession? Are we not going to have a recession for well over a year now? And for well over a year, everybody that is in that recessionary camp has been wrong on the recession because they're always like, it's coming down right now. Think about Jamie Dimon last year. It was probably 4 quarters ago at this point where Jamie Dimon made his comment that there's a hurricane
coming,
forming, right? And that was 4 quarters ago. And yet Jamie Dimon just in the past week and a half reported JP Morgan earnings, and it was a rock star standout earnings report in that environment. So when you're debating the recession, are we going to have a recession? The answer is yes. The answer will always be yes to that question. We've had 11 recessions since 1950. We've had 14 recessions since the 1920s. The answer will always be a yes to the question of, are we going to have a recession? The question is, do we have the data necessarily at this point to project a recession down the road a little bit? And my argument is no, we don't have that data as of yet. You have concerning data. You have speculation tied to the credit crunch coming out of the banking industry that certainly could spark a pullback in consumer spending, a pullback in lending, and so on and so forth. And that would have an impact on that recessionary conversation. But when you're looking at specifically the data, and the reason I think this is a really relevant conversation this week is we get the advanced GDP report this week. It comes into the market, and if you'll recall, when you're looking at the GDP report is a three-pronged approach when it comes to understanding an economic indicator. You get the advanced report, then you get the you get the advanced, and you get the preliminary, and then you get the final report. This one's the advanced, and so there's going to be a lot of conversations regarding the advanced GDP report this week. There's no doubt about that. The question is, what does that advanced GDP report indicate coming out this week? When you're looking at that economic conversation, you're probably going to come in north of 2% on the GDP mark. And that's an improvement over last quarter, and it's an improvement over the longstanding projection at the Fed right now. And so are we going to get it in the next quarter? Probably not. Are we going to get it on the back half of this year? Maybe, but most projections are now pushing into 2024. And the reason most projections are putting it into 2024 is despite what we're seeing in the concern of the banking crisis, despite what we're seeing in the concern of economic data out there, such as the New York State Manufacturing Index or some other indexes out there, you're still dealing with the labor market that is at 3.6%. It is really, really difficult to project a recession with a labor market that is at full execution right now. Anytime the labor market's been underneath 4%, nobody's going to make an argument that the labor market is weak. Now, can it get weaker? Certainly. But we haven't seen that as of yet. And where we're going to see that is not necessarily in the actual labor market numbers. It's going to be on the initial claims side. And right now, we got initial claims last week. It came in around 230,000. Mark, when you look at the initial claims in recessionary timeframes, a normal week of initial claims is 200,000. That's a normal week. That's every week for like the last 20 years in the market. When you're dealing with recessions, you go back to any recession in the last 5 recessions we had, initial claims are averaging around 350 to 400,000 on initial claims. We're not sniffing that yet. Now, the pandemic was a little bit different, but in the pandemic, we were sniffing 2 million initial claims, 2.4 million initial claims. That's a bloodbath when you're seeing in the labor market. We haven't seen that. We haven't seen that at all. We've seen X company make an announcement of layoffs. We've seen X company make an announcement of layoffs. We haven't seen it across the board in every sector, in every industry. And so are we going to have the recession? Once again, the answer is yes. Is it in 2023? The data as of right now suggests no.
Yeah, no. And so no resolution there. No recession probably means no rate cuts, right? I think, when with the Fed that has been in the last week hell bent on inflation fighters. We bought the t-shirts, we bought the hoodies, we bought the beanies, we got the apparel, and they have been very adamant.
We got matching outfits.
Yeah, I mean they're coordinated. They are synchronized outfitting out there in their dialogue. Like no recession, no rate cuts means we're in this. I mean, we're basically in this like holding pattern from a macro theme, right? Inflation, almost everyone is in the inflation's going to recede. But at what rate? Like the guy I call the smartest man on Wall Street, Mohammed El-Erian, said, like, listen, don't be surprised if it's sticky here. Right? Just because it's coming down, the rate of descent. I mean, it's Groundhog Day every day in the market right now, Matt.
We've went from 9% down to 5% CPI inflation. I think we can call that a good reprieve from where we were. But we still have a tremendous amount of work to do. And you cannot expect the speed of the velocity from 5% to 2% the same way you got it from 9% to 5%, because a lot of that was supply chain coming back online and just, time spent away from the pandemic spending that we saw throughout the entire world. And so, 5% down to 2% is a much bigger job in my estimation, than 9% down to 5%. Even though it's like, when you think about the math, it's like, well, you just got to come back down 3%. You've been averaging over the last 6 months, 1.8% on the monthly. That averages out 12 months to 2%. Well, there's a lot of stickiness to that inflationary conversation as you work down into that 5%. And some of that stickiness to the inflation conversation is price gouging at the corporate level as well. And so when you're looking at this 5% number, the Fed still has a job to do there. And when you're looking at the labor market at 3.6% today, with signs of weakness, but not real true signs that would concern the central bank over the course of the next 2 weeks before they go into their next meeting. So it does look like as of right now, we get another 0.25. And where your question and comment was kind of leading into is towards those cuts that are anticipated down the road a little bit. I'm not sure we're going to get cuts in 2023 based on the things we know today. But there are things we don't know today that if the Fed continues to raise interest rates, that they may break something else in the economy. And it's at that point where the Fed would have to aggressively come off their higher for longer type language, and we're going to continue to push interest rates up. Kind of like when the banking crisis hit, Mark, initially, it was like, oh, Fed's not going to raise it all. Fed's done, right? But what they do, they raised another 0.25. That's what they did. And it was a few weeks later when they saw that the damage to SVB and Signature Bank and Credit Suisse was not systematic throughout the entire system, but it was really just a few regional banks that could have, went further if you would have had a bank run. And so they did make some changes, but the one change they didn't make was actually coming off their 0.25. So it does look like we have another 0.25 in front of us. I do think that's the last one, but I wouldn't even do this one. I think it's absolutely ridiculous that we're even doing this one. But at the end of the day, the Fed's not going to call me up and ask me my opinion. They're going to look at the landscape. They still have a job to do on inflation. And they're probably looking at the labor market, Mark, and they'll never say this in front of the microphone, but they're probably looking at the labor market and they're saying, listen, we have lack here to give up. We can give up some of the strength of the labor market to see some more continuation on the fight against inflation. And they're hoping that does not spiral out of control is what they're hoping it doesn't. They're hoping that the further they raise interest rates, that it doesn't break the backbone of the U.S. economy, even though it did show some signs over the last 6 weeks of it actually starting to have a pretty big impact on the U.S. economy. And so it's going to be interesting to see what they do. But as long as that labor market stays as resilient as it is, the Fed probably has the argument that they're going to continue to raise rates and keep those rates higher for longer.
All right. So we could have for an extended period of time where recession, no recession, Fed holding, inflation, this and that, right? Every data point microanalyzed and then forgotten the next day. That creates a lot of nothing.
Can I make one comment to that, though?
Yeah.
Because we're living in that conversation right now, right?
Mm-hmm.
The recessionary.
And I'm painting a picture where we live in that conversation for a while.
Right. But for those of you that are a little bit newer to the market, just from this one old dog talking about the market and been around a day or two, I've been having these debates on recession and will we or will we not go into a recession almost every year since 2013. Almost every year, specifically since 2015, that there have been people projecting recessionary conversations. And the only time they were actually accurate on the prediction was the pandemic, which nobody predicted. And so these conversations of recession, will we or will we not, oftentimes do live in the market, not just in a moment in time, but over time.
Yeah, no. And so not a lot of easy things. Now, I'm a self-identified thematic investor.
Mm-hmm.
I don't have a lot to work with. And so now it really breaks down into sector stories, individual company stories,
mm-hmm.
right? If recession is a checkmate, if Fed pausing is a checkmate, if inflation is a checkmate until we see a data point that moves the needle one way or another, it's like, all right, I don't got a lot to work with from a thematic, bearish or bullish, right?
Yeah.
So it comes down to like individual sector, individual companies, and that's where earnings kick in, right? Mm-hmm. That's where in news events, but most of the time, 99% of news on a company, if you're not named Tesla, who generates its own news every day through one way or another.
They all do. Apple, Microsoft,
but your average company, Matt, like, your average company, they got one news story a quarter, and it's called their earnings report.
Give me an example. This week, I reported on probably 45 companies in the halftime report, about give or take a few companies. And I talked a lot about companies that I never would talk about if it wasn't earnings season. And it's not that they're not compelling technical conditions or there isn't potential trades on those companies. It's just that in between earnings, if your name isn't Netflix, or if your name isn't Tesla, or if your name isn't led by some very, very popular or infamous dude or gal, there's just not a lot of conversations on companies like Abbott Labs or Intuitive Surgical or, HCA or the healthcare companies that reported this week that I just named that, you're talking a lot about right now because what they did on earnings. And so, yeah, Mark, I would say for 90% of the entire marketplace, they just kind of live there. They become stories around earnings because earnings is the most important and most relevant moment in time for almost every company out there. Not just the companies with a lot of follow, and not just the companies that are very popular and big brand names and big box retailers and so on and so forth. But it is important for every single company because it tells the investors, not the traders. Traders will use earnings environment, but it tells the investors how well they're doing. Remember, you buy a stock, you're an investor in that company. The company's got to tell you, hey, how'd we do on the quarter? How'd we do on revenue? How'd we do on earnings per share? How we doing on debt? How's our forward-looking guidance? Mark, if you were an investor in a private company and you had a moment to sit in a meeting with the CEO and the board of directors to tell you exactly what is going on in the company, what they're looking at the future, that's going to help you make decisions around that company. And so earnings becomes extremely important for for me, it's more important than any economic report out there, even though economic reports by far get more clicks and headlines than, for example, the PMI report got a lot more clicks and headlines than, say, XYZ company out of the S&P 500 that reported earnings last week. But to me, the backdrop, you're talking about themes forming in the market. Themes can form economically, themes can form fundamentally, things can form from a geopolitical standpoint. But Mark, if you want a number one theme to be able to drive price action outside of a day, outside of a week, it's an earnings theme. And because earnings are real, it's not the conversation over it. It's, Mark, when you and I are debating certain economic reports in the market, you and I both know that that's not the 1000% accurate number coming to us. We know that, for example, we get Chinese economic reports, both you and I are like, okay, it's in the zone, but we don't know exactly if that's the real number. We get U.S. economic reports. Yeah, okay, we know it's in the zone, but a lot of these are provided from
they're fudged. Let's call it what it is, right? They're I mean, listen, and if you're like, oh, no,
every
people,
they all do it.
Government attempting power. Look at the human history. The history of the entire human civilization has been governments trying to protect power. It's not just
Democrats doing it now. Everybody does it.
So yeah,
power, you do it.
Yeah. So fudging a couple percent on a number, right? It's, of course they do it, right?
Everybody does it. But if you do it from an earnings perspective, you're going to get in trouble with
yeah, that's a different story. Yeah, because you don't have...
You can go to jail on that one.
You can go to jail on that.
So these are real numbers coming in that set the foundation for a company over the next, certainly over the next quarter, but really can be something that triggers something longer term as well. I take a company like Las Vegas Sands, for example. Actually, I'll save that for a little bit from now, but Mark, when we're looking at earnings in general here, there's
because you have this blended growth number that you have, and I got several questions on earnings so far because we got a big week ahead, right? Amazon and Microp and tons of companies. Like, it's a big week. Google, I mean, it's a big week, but we got a little cross section that's come in, and what? My first question is, in general, really low expectations, right? A earnings recession, if you will, contraction is the baseline. And now it is a question of, well, how big are we going to, are we going to beat those really low expectations? How's companies doing as a whole coming in?
Well, and again, when you're looking at the general landscape of earnings, number one, FactSet, got to throw out a shout out to FactSet, because FactSet makes my job in analyzing earnings a lot easier. They're a great company when it comes to understanding the earnings landscape. And so a lot of the numbers I do get from FactSet, and I just wanted to clarify, I just want to make sure that was known. Number one, there's three things I like to look at in earnings. There's a lot of other things, but if there's three things I track, it's total EPS beats against the 5-year average, total revenue beats against the 5-year average, and then I like to look at, and they're always cross comparing against previous quarters as well, but I like to look at the 5-year average. And then that blended growth number that you reference here. The blended growth number is an EPS number that you basically track from companies that have reported earnings. For example, there's 18% of the S&P 500 has reported earnings so far. That leaves us upwards of around 400 companies yet to report. And so when we started earnings season 2 weeks ago, the blended growth number was at a negative 6.7%. A lot of that is based on what is expected by the market, either through companies offering guidance or analysts offering what their expectations are. And so you have the blended growth number, which is the expectation of what the market's going to do throughout earnings season. That expectation was supposed to be negative 6.7%. And when you're looking at how good earnings is, we're looking at, has that number improved over the course of earnings? Because it always does, Mark. Remember, earnings, people lower the bar going into earnings, and on a good earnings season, you'll see that number improve throughout every single week. By the way, this one's that big week. This one's the big week for the blended growth number, because you get a lot of really big and really important names coming in. We'll talk about that here in 1 second. So we started earnings season at a negative 6.7% growth. That's where we ended last quarter at, by the way, was right at that negative 6.7% number. Last quarter was really, really bad earnings season. We started off at like negative 2%. We ended at a negative 6.7%. That's why a lot of anticipation for this earnings season was certainly going to be there. That blended growth number right now is at a negative 6.2%. So we've had slight improvement, but only slight. We didn't get Netflix to support it. We didn't get Taiwan Semiconductor to support it. We didn't get Tesla to support it. What you did get last week was things like Goldman Sachs, Las Vegas Sands, and DHI. And so out of your, and I wouldn't exactly call Goldman Sachs, Las Vegas Sands, and DHI aggressive growth-based companies, whereas Tesla, Netflix, and to a certain extent, Taiwan Semiconductor certainly are growth-based companies. And so the beats you had when you're looking at that number last week, you had a really good beat on Goldman Sachs. They were a standout, Mark. They revenue increased 77% year over year. That certainly added to the conversation. Las Vegas Sands had an absolute just amazing beat on EPS expectation. Las Vegas Sands also produced the first positive quarter since the pandemic hit as well. They were a standout on the week. DH Horton pulled off the only hat trick last week, coming in with a really good beat on EPS, really good beat on revenue, provided an awesome forward-looking guidance report. And so you had some good companies report good earnings that certainly aided, but then you had Tesla report in line with some concern for on net income. Then you had Netflix report in line basically, but missed on subscriber growth and then downgraded their forward-looking guidance. You had Taiwan Semiconductor report in line, but they also downgraded a little bit of their forward-looking guidance. And so you had some good last week, you had some bad last week. And I don't want to say Tesla's, Netflix, or Taiwan Semiconductor's report was bad. They weren't, but they were bad in the sense of where the market needs them to be. And they had really good growth, especially Netflix and Tesla on the quarter, and really over the first of the year. They got to do something on top of that to see that continue, and they just didn't. That's why I put them into the bad camp. But on the net, that resulted in a 0.5% decrease in the blended growth number, or increase, excuse me, which went from 6.7% on the negative down to negative 6.2%. But Mark, this is the week where this number needs to jump. This number needs to jump this week. And the reason I say that, Mark, is it's not last week. It's not the week where it's just a few aggressive stocks and a few defensive stocks and a few cyclical stocks. This week, you have 177 companies reporting earnings. Of those 177, you get juggernauts. This is the juggernaut week. You get Microsoft, Google, Amazon, Meta, you get ExxonMobil. But Mark, when I look down the list, almost every sector.
Every sector.
Materials, it's specialty chemicals and Newmont Mining. Energy is Exxon and Chevron. Finance is your credit card week with Visa and MasterCard. Healthcare has been a standout so far in this earnings season. They've had some really good reports with ISRG, Abbott Labs, HCA, but they also have Lilly, Merck, and AbbVie this week. Industrial, quietly, industrial's kind of that, doesn't get a lot of love, doesn't get a lot of talk, doesn't get a lot of visibility. Industrials just is one of those sectors that just doesn't get the same type of eyes on it that a tech space does, even a consumer staples space. And yet in industrial this week, you have UPS, Raytheon, Honeywell, Boeing, Caterpillar. Staple week. Are you ready for the Coke versus Pepsi challenge this week? That's one of my favorite moments in earnings. Everybody's got their dog. Everybody's got their bias towards Coke or Pepsi. Well, we find out who's doing better this week. Is it Coke? Is it Pepsi? In discretionary, you got Amazon, McDonald's, you got GM, you got Tractor Supply. And then when you look at the growth, it's Google and Meta in comms, it's Microsoft, Texas Instruments, Intel in tech. And it's just one of those weeks where it's all eyes on earnings. It's the one that sets the stage for the rest of earnings season. And if you're waiting on a theme here, Mark, this is the week that the market certainly can find a theme, whether it's on the positive side or the negative side. You got probably, and you probably got 10 legitimate catalysts that could spark something this week. It's one of those weeks.
Who's doing the best out there right now from a sector perspective?
Finance had a really, really good start to earnings, but it was a really good start against some dire expectations. And so they had a really good start to earnings. They came in with about 90% beats out there. But if I were to say there's a standout right now, it's healthcare. I do think healthcare has had just beat after beat on both the EPS and the revenue front. They've had a couple really good reports out there as well. And so I would say healthcare really stands out to me on the bulls side of the equation, just from an earnings perspective. When you're looking at, if there's one sector that I'm a little bit concerned about, Mark, I'd be a little bit concerned with energy here. Energy has not had the standout reporting season, and we get Exxon this week, we get Chevron this week, but Schlumberger kind of underperformed, and they really do set the stage for the energy conversation. And then after Schlumberger reported, you also had some downward revisions in some of the expectations in the energy, and realize expectations were already downgraded coming into earnings. You've seen some follow through downgrade of expectations in the energy space over the course of the last week and a half or so. But again, I don't think you can confirm anything in energy until you hear from the big dogs, and that happens this week as well. So stand out on the bull side, I would say healthcare stands out. I don't think anything stands out on the bear side yet, but I do have a little bit of concern in the energy conversation.
And that's the problem with the bearish case right now, right? The bearish case is predicated on two things. Not just slowing, disastrous economic results that weigh on disastrous earnings reports. It's been the whole case for Mike Wilson. It's been the whole case for a lot of other people, that you would eventually see not just denigration, but severe denigration in earnings.
They better be right pretty quick.
And they better be right. And this is the problem. Like, being early in this business is wrong, right? Like,
you never want to be first, and you never want to be last.
Like, it's why people that are actual professionals make fun of the doomsayers that are always saying the end of the world is coming. That is great.
We hear it every day for 20 years. Yeah.
But like, what practical, if the whole world ends in 35 years, well, my puts are going to expire.
They are.
Right? My puts are going to expire long before. Like, I mean, there have been so many stories over the years, right? That's the old saying. There's a reason this is a truism. The market can stay irrational longer than you can stay solvent, if it's even being irrational in the first place,
Mark,
right?
Listen, we can talk about recent situations involving Michael Wilson and all the bears out there that expect downward movement in price and so on and so forth. It's very hard to predict the timing of it. One of the most important economists over the last 100 years, and there's been some really important economists in the last 100 years, some of the most important economists that have impacted and influenced the way we see economics, the economic landscape around the world, not just that from a government perspective and through an economic design perspective, but how the central banks behave as well. I would have to put John Maynard Keynes up there in the top 3 of influence on, however you see the influence. That's not what I'm saying. I'm saying the top 3 in how they did influence the way we in the U.S. and other countries around the world saw the economic landscape conversation. And he predicted the Great Depression in the 1920s. In fact, he shorted the market, Mark, because he was predicting the Great Depression. He's one of the most influential economic philosophers of the last 100 years. He was dead right on predicting the Great Depression, and it was also his book and influence on FDR that led to a lot of what they did to recover in the Great Depression, that created Keynesian economic analysis that dominated the landscape for 50 consecutive years and is still very, very, very influential today. And yet he went broke on that, Mark, despite the fact that he had all the analysis, despite the fact that he was dead right, he was wrong on the time. And how many times have you seen people like that?
It's a common story.
It is the common story. It's really, really, really hard to get the timing right on a recession. So are we going to have a recession? Yes. Is that going to happen next week? No. Are we going to have more conversations on it? Probably.
Yeah, I know. And so, like, I'm putting together these pieces, man. I want to get into commodity. Do you have any other tidbits on earnings before we wrap up?
EPS numbers coming in at 76% right now. That was obviously going to come down. They started the first week at 90%.
Yeah, they started on fire, and
that was obviously not going to happen. They're coming in at 76% right now, Mark. The 10-year average, the 5-year average is right around 77%. So it's slightly less than the 5-year average, but they're beating the average by about 5.8% right now. That probably does need to improve on the veracity of beats for the market to get any semblance of growth out there. Revenue coming in at 63%. I expect that to come back up and match up into the 69%, which is the 5-year average. So I think EPS beats come down a little bit, revenue beats come up a little bit, but they're close to matching some 5 and 10-year averages right now.
Yeah, no, and I ended the week very crabby. In fact, I was so crabby, you had to call me up and say, "Are you okay?" And I'm like, and I was just like, this market is just messy.
Well, right? we had a really fun scouting report meeting, and the energy was really high, and the coaches were enjoying each other's time.
Except for me.
And there's Mark, and we're all, Mark's over there crabby, and I'm like, okay, I'll just let the bear be the bear over there.
And not the bear as in the market bear, just I meant crabby bear.
Crabby bear, right? I'll just let the bear be the bear a little bit. And so I called him up afterwards, and I was like, hey, you doing okay? Because, we've had some family issues lately, right? And, we lost our father a little over a month ago. And, every now and then, one of the two of us will get a little down and the other one would be like, hey, are you okay? And so that's all that was. And you're like, yeah, I'm just so sick of the market right now. Just do something. I'm like, Okay, yeah, give it time. This is the week it's going to do something.
Yeah, no, and it's just the themes in that, and I think whenever I see a bipolarness to market action, it does make me frustrated. And I saw that in commodities this week, right? Yeah. All right. So we've talked about recession, Fed, inflation, earnings, all this. On one hand, Matt, this week you had things like copper and iron ore and crude oil selling off on demand recessionary fears. On the other hand, you have precious metals selling off on, well, the recession isn't coming.
I know. It's crazy.
Right. And so it's like, so the commodity space right now.
Somebody's wrong on that. But
yes. So like, listen, I know markets are right. Market is a little
market ain't efficient right now.
Right. Efficient right now, because you literally had half of the commodity space selling off on recessionary fears and half of it selling off that the recession isn't coming. Right. And so, and it's just like, oh, the things are so.
And the recession isn't coming is it was selling off, dollar was going up. Right?
Yeah, so that means dollar going up
on economic reports, such as PMI numbers on Friday came in better than expected. You had a couple other economic reports where you had slight beats, nothing too aggressive on the bull side, but dollars going up on that, and that's putting pressure on the precious metals environment, right? But then out there, you also have, because apparently we have nothing else to talk about other than recessions these days, a massive conversation happening on all financial media right now. Hey, are we going to have that recession? Or are we like, at least this week, they're not going to.
Oh, and everyone has a take.
Okay. At least this week, they're not going to struggle for content. You're not going to have a lot of recessionary conversations this week because they're financial media.
Names are too big.
By the way, if we say recession enough, it's just going to magically appear in our society. So this week, they're going to be talking about earnings. They're going to be talking about that. So we're not going to get a lot of that. But you're right, Mark. You had the dollar going up on some positive beats from an economic report perspective. That put pressure on gold. That put pressure on silver. That put pressure on copper. But then outside those direct one-to-one impacts on the dollar versus the commodity space, you also had the conversation of recessions like you're talking about. And whenever that happens, you're going to see companies like Rio and Vel get beat up pretty good because they're very cyclical dependent there. One way or the other, that can't continue.
Yeah, I mean, it's just a disconnect. And so when I see disjointed price action, right, from a thematic standpoint, it's like, it forces me to sit on my hands, right? Like, I'm going to do less. And when I'm doing less, I get crabbier, right? Because I like to trade.
You want to sell that naked put.
Yeah. I like the action. I like things in motion, right? I like, I like this, but that doesn't mean that there aren't times where I'm like, force myself, because I'm 52, not 22, right?
Let me ask you a question. You were a professional poker guy.
I was.
And you were an extremely patient professional poker guy.
Oh, I wasn't. It wasn't about flashing.
You wouldn't come in there with gold chain and say, "Look at me."
No, I wasn't walking into John Malkovich's room saying, "Let me put all the money on the line and let me see if I can see how you twist your Oreo
you're not
cookie."
The poker player that if you're on the button and you got a 2-7 and you got somebody raising in front of you, that you're going to go in over the top, just trying to
1 out of 500 times maybe to keep people honest that I might be playing with, but yes,
90% of the other
99 point
you're playing your cards.
A straight up player.
You're playing your cards.
That's how I made a living for so many years, is I just played it straight up.
And Mark, if you had to run a bad cards for 2 straight hours in a session, you wouldn't be forcing it. You'd get up, go for a walk.
It literally is the dumbest thing you can do. You can't make a living that way.
And so I think you see where I'm going with this.
No, I know, and these are the lessons I've learned in a lifetime of gambling, right? Like
patience is a position.
But I mean, I like it.
No, I'm not trying to get you to enjoy this, right? we all listen. I speak as on the directional side of the equation. If you're,
oh gosh, it's it. Like, yeah, I can't even imagine from the directional side.
The directional side is whipsaw everywhere right now, trying to fight this breakout, and now you're in earnings season, and it's just one of those things. It's like, yeah, this week specifically too. This week specifically, I think it pays to be a little bit patient this week.
I think so.
I think it does, because if we're trying to catch a trend, and I think that's what we all try to do, is catch trends. We don't try to catch a trade. We try to catch a trend. There's always a trade out there. There's a trade. You can go force a trade on any company you want. As an option trader, you can go get all creative like Coach Gino does and go do this butterfly and that back ratio spread and this inverted here and this ratio trade there. And you can get all creative. I think we're over analyzing the environment a little bit. I think we're trying to catch a trend. And think about just in the last 6 months, Mark, there's been 3 or 4 times in the last 6 months where we've been able to catch a trend in the marketplace that didn't just last 2-3 days, but lasted 2 to 3 weeks. And in those environments, it was really good. And everybody's like, oh my goodness, this is great.
That adds to my crabbiness, because every one of those trends came after a sell-off.
You're right, they did. And
I'm not talking, I don't need a big sell-off. Pull back a couple, I mean, like, right, but they did
catch a trend on a breakout the same way you can on a reversal.
Well, I haven't seen one of those in 15 months, so
it's been a while. Okay, so you're right. We have not seen a major breakout result in a trend without a sell-off first in the last 50. You are right. You are right. I cannot fight.
So that's why I'm crabby, right? You know, that's why I'm crabby.
But Mark, 4,200 zone has clean air above it. There's a battle ensuing.
Well, and here's the thing. The best bullish case I can make, and I actually think it's a pretty good one, is the apocalypse postponed. Like, it is a terrible environment for bears. Like, recession, postponed. Earnings recession, postponed. We'll have big data points on each of those.
A terrible environment for the bears does not mean a great environment for the bulls. That's what that means.
But if you get just a little optimism under that apocalypse postponed, right? I mean, you know, just like
I look at earnings projections, Mark, and if the bears aren't right on that economic conversation, earnings are supposed to come on fire in the fourth quarter. The economy is supposed to pick back up in the fourth quarter. I would be a little bit surprised if the economy doesn't pick up in the fourth quarter. And so
you get a little bit of optimism behind that apocalypse postponed, that not just postponed, but hey, because in January there was, because here's the thing, man, this is the last point on my crabbiness. In January, we had broad participation. You had broad participation everywhere. Like, it wasn't just Apple was partying, right? Microsoft partying, but lots of things were partying in January, right?
The March run didn't have everything, but the January did.
The January had broad, because there was genuine optimism.
Bull trend so we got a bull trend in January. We got a bull trend in March.
Oh, this last one is
February. We got nonsense in April. So I can spot a trend here, Mark. I can spot a pattern. Does that mean bull market in May?
Well, and this week sets the stage, right? I don't know. Maybe the number's going to come out terrible this week, right? Maybe you're sitting at 69% beat at the end of the week, right? And bulls just aren't optimistic. But I got to see broad participation. It can't just be a couple companies carrying this market, right? Like Apple has Matt, do you know, like in
Apple, the FANG stocks carried the entire market for 5 years. People don't understand 2013 to 2018 market. It carried for 5 years, Mark. 5 years. 5 years.
I think 0 interest rates had a lot.
Not 5 days, not 5 weeks. 5 years. You're right. Interest rates obviously played a role in that 0 interest rate environment, a lot of quantitative easing. You're absolutely right there. But they also carried a lot of stocks that weren't great up to really high levels too there. And so I
gotta see those stocks starting to get carried, because they're not.
I got it, but Apple's got broad shoulders here. Well, if you added up every company that reported earnings last week, I'm not sure they exceed the value of Apple.
Pay attention to small caps. pay attention to small caps, how they're doing, right? Because they didn't really, they didn't participate in March, right? They didn't participate. They participated in January, didn't participate in March, really haven't done anything in April, right? If you break out of that short-term resistance, if small caps start trending, I'm going to be a lot more optimistic, a lot less crabby.
Well, right? That's because small caps can catch up even if the S&P doesn't go, right? And that's a little bit of a catch-up trade there. So it'll be interesting on small caps. That is a good call out by you, actually, because if we're debating the economy and we're trying to understand the separation of the big cap tech stocks that have provided a lot of value to the market.
They've been carrying the weight. They've been carrying the weight.
Small caps haven't participated. Nope. If small caps start to participate and they start to break out and run,
bears better cover.
Bears, oh yeah, I would agree.
If small caps start to participate, because if small caps are participating, then probably some of the lesser components in ARK are going to participate. Probably a lot of things are going to start participating, right? And that could lead to a sustained breakout of 4,200, right? So pay attention to small caps. IWM, put it, even if you don't trade it, even if it's not a thing, track it. I think it is a really good poker tell in the coming weeks,
especially when we're debating economic conditions.
And since that's kind of the
conversation. Yeah.
So pay attention to small caps. I think
the economic conversations, as we expected, have overtaken the central bank conversations, the inflationary conversations. Would you agree with that, by the way?
Yeah, we've shifted themes, and now it's just, do we go into .com or do we go into, hey, no, it's actually, there was a lot of stimulus in the money, not a lot of workers. We held our own.
It really is. Do we have a one last leg down saga in front of us? And unfortunately, kind of like season 7 of 8 of Game of Thrones, we don't have that story written yet.
Yeah, no, it's.
I had to. I'm sorry.
Like, I was starting to feeling better. I was starting to feel better there for a minute.
Listen,
right?
We both rewatched it in the last year, and you came away with some nonsensical. Oh, it was okay. No, that's revisionist.
I just last subject. That I have on my plate, just talk about gold specifically for a couple seconds. Adding to my crabbiness, right? Recession isn't come. Fed higher for longer out there, just preaching it, right? I think I don't have Mormon missionaries show up at my door here in Utah. I have Fed speakers show up on my door saying, can we preach the gospel of higher for longer to you?
Oh, they preach it. They preach.
Do you know that we want to sustain rates for a long time, right? Like, as long as we, right? Like, come on. I mean, I was just getting tired of it. Ever since, not this past Friday, 2 days ago, but 9 days ago, you had two things. You had Michigan inflation expectations come in hot, and you had Waller give a very hawkish speech.
Yeah.
Volatility shifted on gold, right? And listen, we just did 3 podcasts that say why you want to hold gold long term. This is not long-term analysis, short-term tactics, right? Covered calls in that.
Yeah.
But, you could have a little bumpy path here for gold in the coming weeks, depending on how the data breaks, right? Depending on how the data breaks. Is that what you're kind of preparing for in the short term, right?
Yeah, I think obviously from a macro perspective this week, we're going to be talking about debating the earnings landscape, and that's the most important conversation. But secondarily, Mark, there is a tremendous amount of economic reports this week. And gold has been showing a little bit of weakness at the top as the dollar's going through some slowing momentum and trend. It has a little bit of a deeper bearish retracement right now. That's putting a lot of pressure on the metals. Now, Mark, typically when I see a deeper retracement on the dollar, I typically will see that coupled with a violation of support on gold. It's been interesting to see gold and silver specifically hold up a little bit better than other instruments like copper. You've seen gold try to hover. It's underneath 2K at this point, but it hasn't exactly screaming down the same way other financial instruments or commodity instruments are right now. And so
commodities took a beating this week.
Oil came down hard. Copper came down hard. Silver and gold, man, they kind of held their channels a little bit. Obviously, you're going to see volatility there, Mark, but silver's still like 3 pennies away from its 9 EMA right now. When you're looking at gold's underneath its 9 EMA, it's underneath its 20 SMA. but it's still a stone throw from the all-time high at this point. When you're looking at copper, copper took a little bit of a beating, sold off pretty aggressive on that economic conversation. When you're looking at some of the other metals out there, and I'm just talking the industrial precious type metals, palladium, Mark, keep an eye on palladium. When we're looking at this week, talking about a little bit of a sell-off, palladium didn't do anything.
Yeah.
Palladium looks really good, and unlike gold and
silver, I missed that in my analysis.
Went parabolic, Mark. Gold and silver had
that's actually not a bad. I'm looking at a weekly chart.
This is a real good reversal.
That's a really good reversal. That's a really good reversal.
And if you want to show where some strength is, go look at platinum out there. Platinum does not want to stop out there. Platinum skyrocketing right now. Palladium looking good right now.
Last week in the markets, right? Like the commodity markets.
The commodity market, it's fighting the dollar a little bit on silver and gold, but platinum and palladium, platinum looks downright parabolic bullish.
Yeah.
Right now. Palladium, keep an eye on palladium. Palladium has a little bit of a high base, following with an inverted head and shoulders formation on the low point. It's coming through a little bit of time correction with a nice little technical correction as well. I don't know. So yeah, I'd look at copper out there, and obviously it's a geopolitical instrument as well as all of these. But I'm not seeing the overall weakness in the precious metals market that others are talking about out there right now. And I think what's happening is
it's relative weakness.
At the stocks. Well, I think what's happening is they're looking at the stocks getting tied up into the basic material conversation and not looking at the raw metal out there. Because when I look at gold, gold doesn't have a bullish trend right now, but I would never call gold bearish here, right? And bullish trend is pivot formations. You're showing some weakness at the top end of the trend. I think gold is one of these weeks when you're fighting the dollar, especially a deeper retracement. It's a covered call environment for gold. Silver still has the ability to set up and run. Palladium coming in off a high base following a reversal looks pretty decent. And platinum, I don't even know what you could do with platinum because it's downright parabolic right now. But I'm not as dire out there on the commodity space as some of these stocks are suggesting right now, because
I think you're dead right. I think you're dead right here. I think there were shenanigans going on this.
Listen, we deal with a lot of algorithms, and we deal with a lot of algorithms in the marketplace, and single stocks can flat out fly. Take a look at the underlying commodity that those stocks deal with to see if there is actual damage there. And as of right now, yeah, I do think gold should be covered because of what's happening with the dollar. And there's a lot of economic reports, Mark. Expect some volatility this week. I think if there's one thing the bulls, the bears, and the people that sit on the fence can agree on, it's, and sit on the fence was not bad. I'm just saying, looking at that this week, is there's a lot of potential catalyst out there. Expect volatility. You got 177 companies reporting earnings. You got a plethora of important economic reports, including the advanced GDP number that's going to have an impact on that. And that's not even without me talking about the Bank of Japan, who also reports on monetary policy this week as well.
Listen, Matt, I don't know if you know this, the CBOE is coming out with the one-day VIX.
That just makes me cry. So stupid.
Now there's not going to be any instruments traded on it yet. But one day VIX.
Yeah, that's what the market needs right now. That's the thirst. More volatility indicators that we can call worthless and garbage and useless, and yet everybody out there that wants content, hey, did you see the VIX? Yeah, but do you even know what that means? Ridiculous.
Hey, Matt, for our pro members, we recently added another thing. We're always trying to create value for our pro members. We've added our option success training that we used to charge for as just a permanent feature for pro members. You sign up for a free pro member trial. You get that option success training, and you're having a training on that coming up. But tell us about that.
Two things. Number one, that class is absolutely good enough to charge a pretty penny for. I made the decision to include it with the pro membership for not only our pro members, because we have a lot of pro members, but a lot of the pro members of Tackle Trading have a lot of experience. But as we get more pro members, I want them to have the same foundation from an educational perspective as some of our veterans out there, so that as they come into Tackle Trading, they're speaking the same language technically. They're speaking the same language from an options perspective. They understand the systems that we apply at Tackle Trading, that other people that they talk to in our community. So they're all speaking the same language, the same rules, the same systems, and so that you can share and help in the journey. Because at the end of the day, Tackle Trading is an educational company that was created so that like-minded traders and investors could help each other out in this journey to financial freedom. And so I made the decision a few months ago to include it with the pro membership, so that we could ensure that we set off all the traders at Tackle Trading on the absolute best educational footing. Because there's going to be moments, yeah, we're in webinars all the time, we're in coaches shows all the time, we're in lounges and labs, and we're in the halftime report all the time. We're constantly there for each other at Tackle Trading. But I wanted to ensure that the foundation of education was always the number one principle that we built upon. And so I made the decision to include the training. It's a 2-day training. It's a live training with Coach Gino Poor and myself. I teach day one, and it's all about technical analysis, learning trends and patterns and support and resistance, and learning the art of the 1, 2, 3 pattern recognition that I designed a few years ago, so that as you're in the halftime report and you're watching me break down something, or you're watching Tyler break down something, or you or Coach Frank or anybody else, you know exactly what the conversation is about. When you're sitting in a lab, you know what the conversation is about. When you're sitting by yourself trying to make decisions for yourself, you don't have to reach out to somebody else. You know what the conversation's about, because you've been there, you've done that, and you built your foundation on education. And so I'm very excited about it. This is our third basic training that we do. It's called the Option Success Training, and we're way excited. And I know we're going to have a bunch of pro members over the next little bit. But again, if you are new to Tackle Trading, or if you are, wondering about this game called trading, and you want to,
it's a great game,
give it a chance to see if it is something for you, I promise you this. There is not an offer in our industry of financial education that will give you more than what Tackle Trading does from an education perspective and an application perspective. You can go out, Mark, I've been around this industry for 15 years. You can go out to Tackle Trading right now, sign up for a free trial membership, and you can get access for the next 2 weeks for free. You could get access to 30 different webinars, multiple mastermind groups, multiple different scouting reports, and you could also get access to 6 hours of some of the best financial training that you will have. And I promise you, at any company I've ever represented in the past, no company has made an offer of that degree of significance and that degree of value, just to make sure you, as the end user, have the proper tools you need to navigate this market. Mark, I've been around this industry, like I said, for a long time. I've taught things in this class that have been charged a boatload for. That's what we do at Tackle Trading. And so if you're sitting on the sidelines and you want to get into the game, this is a perfect opportunity to get into the game with a company like Tackle Trading and get the education you need and get the help in application as well.
Yeah, man. Well, trading is such a great game. It is
it's not a solo sport. It's not tennis.
It's such a great game, and it's fascinating to me. Fascinating to me. It was fun. Even when I'm when I get crabby, that's because that means I'm gonna do like 40% of the trades I normally do. Because I love the game. It's a fun game. And we're going to have a lot of pieces to the puzzle of that game fill in this week, I am feeling,
I think so.
Or maybe it will be punt and we'll be back and we'll go, all right, cash flow plays, right? Whatever.
If we're still sticking between 4,100 and 4,200 zone next week by this time,
I would be surprised.
I would be very surprised.
Too much this week.
I didn't make that statement 2 weeks ago.
No.
Didn't make it last week, but I would be very surprised this week. There's just too many potential catalysts out there.
And even if you end up there, it feels like you might go on one side or the other for a big stretch before coming back, right?
Let me rephrase. You may end up there, but it ain't gonna be
the same journey the last couple weeks.
It ain't gonna be doji day on Google Day.
Yeah, I agree with that completely. Listen, we appreciate all of you out there. If you ever need anything at all, if you're interested in my trading lab, a Tackle Pro membership, just learning more, email me at team@tackletrade. I answer all the emails. Be happy to help you out. But have a wonderful week, everyone. We'll be back with 525 next week.
Later, team.